all right. Good evening, everyone. Welcome to today's special edition of the Black Builders Network Masterclass. As usual, it's powered by Founders Connect. Um, Tonight's masterclass is a very critical one for every founder, operator, or aspiring entrepreneur that is here. All right. We are diving into a question that really defines the trajectory of many startups, right? Should you bootstrap or raise with angels or go to the VC route? Um, each of these parts, we know they have their promises, but we also know that they have their pitfalls. And with it, ecosystem like ours, where the rules are shifting, having clarity has never been more, important, right? So that's why we're excited to have Tolulope Osho lead us through this conversation today. In case you are unfamiliar, Tolulope is not just a founder; he is okay. So he's not just a founder; he's the founder of Pesa Peer Inc. Now Pesa, right? Is also a seasoned technologist and business leader with deep experience in both building and backing innovation. Like I already said, he's currently the co-founder and CEO of Pesa, a company that he has been leading since 2020, where I like to think he's actively navigating the very decision we're about to discuss today. Right. If you don't know Pesa, Pesa is a remittance uh, product that you can use to send, cross-border payments from Canada to Nigeria and many other corridors, right? So before founding Pesa, Tolulope has built an impressive career in tech, holding engineering and leadership roles at global companies like Logitech, CW, Cisco, where he worked across solutions architecture, enterprise technology, and African market strategy. His journey began, my research, by the way, as a network specialist and has since spanned roles that combine technical depth with business impact, right? So yes, this is Tolulope. Whether you are thinking about, scaling without giving up equity, or if you're curious about, when it actually makes sense to take external capital, or simply just want to learn from someone who is currently building, this masterclass is for you. So yes, please join me as we welcome Tolulope Osho to take us on this masterclass.
Yeah, thank you very much.
Let me
Yeah,
see,
thank you
let
very
me
much.
see clap science, please, if you're here. All right. Let's get started. Let's
Okay.
get right into
Yeah, thank you very much. Thank you very much for the introduction. I'll share my screen because I have a couple of slides to share as we
it.
talk about this. Um, Let me know when
Um,
you
also,
can.
guys, please note your questions down in the chat box as he's speaking. When he's done, we can then entertain the questions and get answers. Thank you very much.
Okay. Can you see my screen?
Yes, we can. Yeah.
Okay, good. Just give me a minute. Okay, I need to share. So choosing your path, bootstrapping angels or VCs. Thank you very much for the introduction. Just to introduce myself again. My name is Tolulope Osho. I'm a co-founder and CEO at Pesa. Pesa is a money remittance app, like you rightly said, for remitting money not just from Canada, but from the US, Europe, United Kingdom. And from time to time, we try to expand into multiple corridors. My background has really been in technology way back from my university days. I graduated from Obafemi Awolowo University. One of the things you are primed to do at OAU back then is what do you really want to be in the future, right? A couple of years ahead of me, I had guys like Tosin at MoneyPoint, Mayowa Dudu Mobile, and I think he owns a couple of fintechs now. And these guys they spent the early time of their years trying to figure out what solutions can they solve, and you look at them and just wonder to yourself, what can you really do? Um, with respect to Pesa, we started off in 2021. We launched our mobile app in 2021, and that was off the back of me trying to send money to my sister for something, and it was quite expensive. I mean, I was sending quite a lot of money, and the more I tried to send, the more percentage I was being charged for that, and it was quite a very painful experience for me, I must say, because I paid quite a lot on that particular transaction. And based off that, I came together with a couple of friends to start Pesa. One of the problems we run into immediately is trying to navigate what the regulatory landscape looked like. And that wasn't even the biggest of our problems. The biggest of our problems was how would we do this without money? One of the things that we learned early on is, well, a lot of people would argue that it requires money all the time, and it does, because we put in a couple of dollars, like $5,000 or thereabouts, into the business. But it doesn't require a lot of money. It just requires the intention for you to go ahead and do something. So what we did early on was my co-founders were way more technical than myself. I held certifications in enterprise network architecture, and which meant I couldn't build a mobile app myself. So my co-founders were what's it called? Were software developers, and that really eased the burden on how we were going to go to the market. Um, from 2021 till 2024, I did Pesa part-time, which means I had my full-time job, 9 to 5, that paid the bills. And I think that really helped a lot with the bootstrapping journey, because my family could still feed. And if you live on the side of the world, I live in Canada, by the way. If you live on the side of the world in which I live, day-to-day expenses can be quite crippling. So I did my 9 to 5. I worked at CDW. I worked at Logitech. And in 2024, I came to that moment where I said, it's time. It was time for me to go full time. And just to give you an idea of what had happened before then, every cent we made, every dollar we made went back into the business. Before then, we made a lot of mistakes. And I must say that because we're all first time founders. And just to also share with you, I never really saw myself doing business. Business wasn't my thing. I was pretty much like a career person. My path was set before me: solutions architect, senior solutions architect, principal solutions architect, then maybe move into leadership or whatnot or something down the road. That was what I really wanted to do before we started working on Pesa. But with our journey, we were able to start with little or no funds. And one of the things that struck us early on was the fact that we needed to get customers to use our product. And even before the back end was ready, I started doing, for lack of a better word, talking to friends, talking to associates about the product we were building and why they should sign up to start using the product. For like 6 months, while we were still developing the mobile app, we had like 300 users that were using the app. And that kind of validated us that we were doing the right thing. And when we launched the mobile app, a lot more people came on board, and we grew from 300 to 1,000, from 1,000 to 10,000, from 10,000 to 100,000 plus that we are today. And all of this, again, like I said, was off the back of not getting outside funding. Now, talking about bootstrapping versus angel investment and VC investment, bootstrapping requires self-funded growth and internal resources, and which is what I've been talking about. The growth you're going to experience in bootstrapping would have to be funded by yourself or by the business. That being said, remittance early on, because in Canada, I think Safe Lemfi, AfriChange, there were a couple more, but we're not quite a lot. So I would consider ourselves as early movers in that space. So we had the space to ourselves, and every dime we made in the business came back into the business to further grow the business. And from a marketing standpoint, I would say that we didn't do any significant marketing until 2023. So all the growth we experienced between 2021 and 2023 were simply based on word of mouth. I mean, our customers telling their friends, their associates to leverage or to use the app. And that was how we grew. Pesa back then. So from a bootstrapping standpoint, you definitely will be running a very lean operation. You can afford to spend when a lot of people are spending for growth. As a matter of fact, our competitors were paying influencers then. We couldn't afford to pay influencers, but we kept growing the way we wanted to grow. And I know the question might would come along down the road as to why we didn't raise money. I would say for a fact that we didn't raise money because the journey to raise money could be quite distracting from what we're doing. At my 9 to 5, I would say that we applied to what's this thing called again? This accelerator. I can't remember their name now, but it's the popular thing out there that people YC, yeah. We applied to YC, and one of the things that YC told us was to go and resign from our jobs to come and focus on Pesa. And we couldn't do that for 500K because, again, what am I going to eat while I put 500K in the business, right? So those were the decisions we made early on that really helped us to, and that really reinforced the need for us to continue bootstrapping up until this moment. And I can say that we're in a very comfortable place that can enable us to really reinvest in the business, continue to grow in the business. Last year, we bought a company in the UK, for example. Again, this was off the proceeds of the fact that we were kept reinvesting in the business. Now, coming to angel investment, pretty much it's raising funds from individuals, often close contact. An angel investor could be your friend, an angel investor could be your family, an angel investor could be someone that was introduced to you by someone. I was reading the story of Airwallex, which is another provider in the space in which we operate in. They are more like an infrastructure provider. And the guy said the first investor they had gave them $1 million for 20% equity in the business. That, for example, is an angel investor. An angel investor usually they don't need to know about, they don't go into a lot of due diligence. They don't ask you for they don't ask to see your finances. They just hear you out. They like what you're saying, and they pretty much want to invest in your business. And that is how angel investment works most of the time. With VC investment, they are pretty much institutional funding. You'd have to pitch to them. In some cases, people pitch to as much as 80 VC funds before they get the attention of maybe 10. Sometimes you get a lot of no's before you get one yes. So that's pretty much VC funding. Now, understanding the different parts with respect to bootstrapping versus external investment, funding your business purely from personal savings is bootstrapping, which again is what we did. One of the things you also did early on was I did a lot of crypto trading between 2021 and 2022, and I did all of that to invest back in the business. Again, I wasn't able to do this crypto trading if I didn't have the license to do that back then. So we pretty much segued into something that had a lot of what's it called? A lot of instant potential for return, but we also knew that we didn't want to be in that space long term because of the regulatory scrutiny on cryptocurrency trading here in Canada. So we did that back, I must say, to inject funds into the business. But one of the things that bootstrapping gives you is you get to retain 100% ownership in your business. Today, for lack of a better word, I don't answer to anyone. And we do business. We're guided by the ambition that we've set for ourselves. One of the things I used to tell my co-founders early on is how badly do you want it? So the things you want to see in the future, how badly do you want it? And let that be the guide for you when you wake up in the morning and look at the progress that Pesa is making or the impact that you think that you want to make within Pesa. One of the what's it called disadvantages of bootstrapping is the financial risk is very high. I've seen a lot of founders rack up credit card debts, line of credit debts, just because they want to invest in the business early on. Sometimes it pays off, sometimes it never pays off. You just want to be sure that you're disciplined with your finances as much as possible, so you don't get burnt in your personal life in the process of starting a business. In our case, like I said, I maintained my 9 to 5. My co-founders maintained their 9 to 5s, and we only became full-time at Pesa when we felt that the business was at a comfortable place, and we also were at a comfortable place to run the business. So, like I said about an angel investor, they are typically high net worth individuals who can invest their own money in a startup or early stage company. They typically invest in exchange for equity and may also provide mentorship and business advice. The good thing about angel investors is their checks are not large. Maybe someone giving you $50,000, $100,000. Some might give you as much as $1 million, depending on how much liquidity they have or how much cash they have at hand and how much trust they have in your business. They typically negotiate with you. It's nothing really deep when it comes to negotiating with an angel investor. You could negotiate over a cup of coffee, for example. You could write your terms on a piece of paper and you take a picture of it and everyone is fine. It's not usually not that stressful. In today's in these days, you have standard terms that you can get off YC, for example, that can guide your conversations with an angel investor. But one of the things that I would always say is that regardless of what sort of investment you're taking, make sure that you have a good lawyer that you're speaking with that can help you understand the terms, because it's very easy to get into a bad deal with someone, whether it's an angel investor, whether it's a VC venture, or even in the case of bootstrapping, you're trying to onboard a co-founder. In the case of VC, a VC is a firm and type of investment firm. They raise capital from investors themselves, known as LPs, to invest in early stage or high potential companies. The difference between angel investment is an angel investor gives you money in hope for the returns that you've promised them. A VC investment nurtures you in some cases towards the sort of outcome they want to see. So when you see someone raise a Series A, for example, there's a good chance they'll raise a Series B. There's a good chance they'll raise a Series C. There's a good chance they'll raise a Series D. In some cases, if they're not able to IPO, there's going to be a Series E. And in most cases, an acquisition would occur. That's the way a VC makes its return over time. In this case, again, like I said, VCs they often take bought seats. So if someone is giving you $5 million, for example, you don't expect that person to go away and never to see again. They demand certain reports from you on a monthly basis. They take a bought seat. They want to know how your business is doing, and so on and so forth. And in most cases, there's significant dilution to your stake in the business, because again, like I said, if you're taking 5 million in investment from someone, you must have a very high valuation not to be highly diluted in the process. So comparing the different funding models, each funding type offers distinct trade-offs in terms of control. Like I said, with bootstrapping, you have full control. With respect to the amount of equity you seed, you don't necessarily have to seed a lot. One of the things we did early on was the investment that I received in Pesa was through human form. I mean, my CTO joining me, and like 4 technical guys that joined me early on. Our front-end designer, my CTO today, my engineering lead today, they all joined early on. And one of the things I had to do was to seed equity to them, so that they could join the business. With respect to what's it called, the risk that you have, your risks are personal to you. No one is within your blast radius. Your risk is contained to yourself. With angel investment, in some cases you have full control, right? Because some angel investment will give you money, and because they don't know what exactly you're doing in the business, they don't care. They just give you money and wait for the returns to come. You have moderate control. In some cases, if you're talking to an angel investor that is very versed in your field of in your line of business, they could try to give you some sort of guidance. And when I say control, it doesn't necessarily mean that someone will come and take over your business. It just simply means that you're going to get guidance, in some cases unwanted guidance, from time to time. But most of the time, anyone that is offering you guidance, they equally want to succeed as much as you want to do. With respect to the amount of equity you seed, you can greatly control how much equity you seed to an angel investor. And if everything goes poof, it's what's it called? The risk is also shared. With venture capital, as you raise more rounds, you get less control. As you raise more rounds, you get less control. I'm sure we've heard stories of founders that were kicked out of their business, and it's not a common thing. but it just means that with more rounds that you raise, you see more control. So if you see a company raise, let's say $33 million at the $100 million valuation, 33% of the company is gone. If they go on to raise another amount of money at a $500 million valuation, some amount of the company is gone. The good thing about, what's it called? The good thing about raising VCs, you get to raise a lot of money early on, right? You get, again, if you raise like $3 million, it's better than not having anything to run the business, especially if you have a pursuit for high growth. And whatever path you decide to go on, it depends on what your vision for the business is. Everything has its own strategic implication. In the case of bootstrapping, for example, you'd have to go with organic growth. In our own case, for example, for 2 years, we pursued organic growth because we didn't have a lot of funds to spend on marketing. Your operations has to be lean, and you have to go at a sustainable pace. And what exactly do I mean by sustainable pace? There are times we do marketing freeze, right? Because there's a level of growth that you can attain that can hamper your business if you don't have the right funds to back the growth up. So let's say on a very good day, you were processing $3 million in transaction volume, and something miraculous happened. You're processing $7 million in transaction volumes. There's a lot of consideration that goes into it. It means that a lot of users have signed up. You have more customers coming to customer support to come and complain about problems. You have your database that needs to expand to take on that much users and process transactions as swiftly as it was when it was maybe like half the number of users. There are a lot of implications that would come up. So you have to learn to grow at a pace at which you can manage when you're bootstrapping. With angel investments, one of the things it gives you is early validation. If someone says take $500,000 and go do this with the business, it gives you the validation that someone sees, in some cases, maybe what you're not seeing, right? Or even validates what you're seeing about the business or the potential growth in the business. It also gives you access to mentors, right? So an angel investor, for example, they are typically rich people. They are typically, in some cases or in most cases, they are businessmen. They've done business. They've seen the highs, they've seen the lows, and they can give you guidance on what you should be doing and what you should not be doing. And like I said earlier, their terms are usually flexible, right? They say, take this money, grow the way you want to grow, return what I want to me, right? As at when due. In some cases, like I said, they come back and give you guidance here and there. And with venture capital funds, it's rapid scaling. They prioritize most of the time growth over profit, which means you have growth numbers you'd have to meet. Number one, you'd have to ramp up on employee hires, for example. You'd have to ramp up on customer acquisition by any means necessary. So if you have 10,000 users today and the VC gives you money, start thinking about how you want to 10x that number. Start thinking how you want to 10x your transaction volumes. Start thinking how you want to. You just have to grow, and you have to grow at a rapid scale, right? And you have to start thinking with an exit and a focus. What is your exit strategy? And that's what our VC is thinking, because they also want to take that money out at the end of the day. So what's the exit strategy? Do you want to get acquired by a larger company? If the answer is yes for you, how do you work, or how do you build your operations such that you want to get acquired by a larger company? So take, for example, a bootstrap company in the remittance space that is processing about $3 million a month, but they're profitable. Let's say profit is 1% of 3 million, which is 30K. Let's just say a VC would expect you to do like maybe times 100 of 3 million, right? And with more users. And the reason for that is the more users you have, the more transaction volumes you process, the more attractive you are to either a Series B investor or another company that wants to play in that space that needs to acquire someone. You are a more valuable, that's a more valuable asset to investors than a customer that is just processing $3 million and is okay with $30,000 in profit every month and just wants to live a simple life. So you just have to think about the strategic implication of the different options you want to go with. And again, what exactly are your ambitions? So when to pursue each path? Again, like I said, with Pesa, We've sustained this by, I think one of the ways we sustain our bootstrapping journey at Pesa is being financially, I would say we're very financially prudent, right? I mean, we don't spend on what we don't need to spend on. If there's no serious return on this expenditure or on this expense, there's no reason to even spend on it in the first place. We prioritize investing back in the business over rapid growth, right? And that's because at the core of what we're trying to do, we want to build a very solid base, a solid core, and what you call a defensible moat, right? So take, for example, I'd rather spend money acquiring licenses in Europe, I'll spend money acquiring licenses in the US over maybe signing an influencer, for example, in Europe, signing an influencer in the US. I'll prioritize regulatory stability over rapid growth in certain regions. And the way we look at it is once we are really established regulation-wise in all of these regions, we can double down on growth. And again, doubling down on growth would mean that we'd also want to grow at a pace that we can contain. Because, like I said, you take money and you reinvest back in the business. When you reinvest back in the business, doesn't necessarily mean you're giving money into the business. It could mean you're taking money out into the business to invest in other things. So take, for example, I said we bought a company in the UK last year. It cost us well over $1 million, for example. That in itself is reinvesting in the business, but taking money out of the business. But if you take $1 million out of the business, it means that you don't have enough float, for example, to pursue the kind of numbers you would like to pursue if growth is top of mind for you. So you have to be willing to wait that period where you're not growing the way you want to grow, or you're just trying to kill back into the space. With angel investment, for example, most times you don't need a lot of pitching to get an angel investor on board. You don't have to do a lot of due diligence to make that to happen. The attempts, like I said, are usually simple. You could go from a few hours to what's it called, to maybe like 2 days. Take it, for example, the story of the lady, the lady that invested in Airwallex. Between herself and her husband, they had some money and they wanted to invest in real estate. They just wanted to buy houses and maybe rent them out or wait for the houses to appreciate. And she stumbled on these two guys that were trying to build Airwallex. And she said she was going to give them $1 million for, I think, 20% equity in the business. They didn't have to say much for her to give that money. Her husband tried to guide her against it from the story that I read. And she said, well, I really don't care. I just have a good feeling about this. I think Airwallex is now valued at maybe, I can't remember, maybe it's like they have like $1 billion valuation or something. And you can imagine someone that invested $1 million for 20% equity in the business. You can imagine how much return that person would have typically gotten out of the business. With VCs, it can be a very delicate story. I don't have a lot of experience with VCs, but from what I've read so far about VCs, VCs typically invest based on interest. There has to be an interest in you, your line of business, the founder setup, the economics of the business. There's a lot that VCs consider when they make investments. The other thing is you could be talking. VCs also invest based on am I investing? Are we focused on Black founders, for example? You could have VCs centered on climate change. They could be focused on female founders. It all depends on what I call VC sentiment. But one of the things I consider gold is finding a VC that would typically invest in your, what's it called, in the field you're specializing in. So take, for example, if I was going to look for a VC by myself, I'll be looking for investors like QED. QED typically invest in fintechs. And what that does for you in most cases is you're talking to people that have significant experience in the field that you're building in, right? So take, for example, you're trying to build the next, let's say, Stripe, right? If your investor has invested in Stripe before or invested in a company similar to Stripe before, there are a lot of learnings that they've gotten from the previous companies they've invested in that they can offer to you as guidance. In most of the cases, they can either connect you with other companies in their portfolio that could maybe offer complementary services. And in most cases, they have deep experience to help you navigate your journey as a founder. There are trade-offs. right? There are real trade-offs. Bootstrapping is very difficult. It's really, really difficult. I hate to say this, but there are days that I've literally like shed tears. I mean, I think this was in 2023 when one of our providers just turned us off. No warning, nothing. We were just turned off and we did not have anyone to talk to. And most of the time, when you're a little or not a known company, people can really afford to take the piece on you. I mean, like who are you who are you to start with, right? So VC, you can go through those moments when you're still early on in your bootstrapping journey and you have very little pedigree to yourself. Uh, Apart from that, having to wake up every day to build something for years with nothing coming back to you, but going back into the business. And again, nothing coming back to you doesn't necessarily mean that you're going to make a profit or you're generating the right revenue. It just means that it's like feeding a baby or it's like raising a child. Before you can say, hi, child, help me do XYZ or help me run errands within the house, the child has to go through a couple of years. You'd have to invest in the child, you have to train the child. And as much as this is the same with angel investment or whether you go with VC investing, they happen faster than it would happen for you as a bootstrapped company, right? So there's always the pain, right? You also need a lot of fine tuning. You need to know when to pivot. And one of my co-founders would say you have to learn how to fail very fast. So if something is not working, you need to learn how to drop it like like a hot iron and move on to something else, or try to find a way to fine tune it. You have to pay close attention to the business to know what works, what doesn't work, what gives you money, what doesn't give you money. I'll tell you, for example, there's an allure for me, for example, to scale the volume of transactions we process. There's something beautiful about processing maybe $100 million in a day or something. There's something beautiful about it. That being said, it comes with the pressure. Do you have what it takes to deal with the pressure of processing that much? So those are the drawbacks of bootstrapping. Because your team is lean and you can afford to hire quite a ton of people, there's a lot you'd have to learn on the go. There's a lot you'd have to automate. There's just a lot to do with bootstrapping. That being said, again, it's just the trade-off that comes with bootstrapping. With angel investment, in some cases, you can get money from people that offer leads to no guidance into the business. They simply give you money and expect returns per agreement, right? So that's one of the drawback of angel investment in the sense that, well, it's still better than bootstrapping because at least you have money from someone to run your idea the way you want to run it. That's the only thing I'll call the drawback of angel investment. In some cases, if your terms are not solid, an angel investor can just come back and say, you see that 350 I gave to you, bring it back, I need my money back. That can really happen, and I've seen it happen to people before. In VC investments, what you're really letting go of is pretty much equity seeding of control, and so on and so forth. That's the only drawback. But again, depending on what your ambitions are, this supposed drawbacks might pale in comparison with the positives that comes with VC investment. Again, like I said, if iPad growth, iPad scale, if you look at the case of Uber, for example, Uber was burning money for the longest period of time. If you look at Revolut was burning money for the longest period of time. And these are one of the most profitable companies in the world right now. Revolut, for example, is one of the most profitable companies in the world. But for the longest time, they burnt a lot of money, they lost a lot of money, and I think they didn't start turning profits until early 2020 or thereabouts. The other thing about going after VC investment is it can take months to close a VC deal. The process of pitching to multiple VCs can be time consuming. You need to pitch to a lot to secure one. But the good thing about VCs are if you find one investor that's willing to take the bet on you, usually the rest, a couple more would come around to form that fund that you're looking for. Again, like I said, navigating venture capital investing, there's a lot of due diligence that is required. You'd have to put out your finances, your growth, your numbers, and everything that you're currently working on. If you're running a very, very well organized business, this might not be a challenge for you. But most founders, if you're a first-time founder, you've not done something like this before, there's a good chance that you're going to be operating from a place of chaos. and that might present a lot of challenges for you. Now, it requires time commitments. So if you don't have the capacity to deal with the requirement of having to put, they call it a deal room, having to put everything you need to do to put them in a deal room, pitch to a lot of investors, and at the same time still run your business, that could be, what's it called? That could be a real work to do. The other thing is you'd have to consider legal protection. In the VC world, pretty much legal, you'd really, really have to, for lack of a better word, lawyer up. You need a very solid lawyer that understands venture capital financing to go hand in hand with you when you're signing the terms. You can really sign bad terms, but most of the time, they don't happen most of them. You can sign bad terms, but they don't, and this is not to scare you. It doesn't happen all the time, but you can sign bad terms. So you need a very good lawyer to help you on that journey. The benefits of VCs, the opportunities open doors to new ventures, connections in some cases, expertise, and deep industry experience. Now, there are real life examples of companies that have been successful, either bootstrapping, angel investment, or VCs. Like I said, MailChimp is one. I think Zoe is another company that attained a $1 billion valuation, I think, without raising any external funds. Wavy Parker got angel funding to start their business, and Airbnb, Uber, early on they got VC funding. Revolut, early on they got VC funding. Wise, Nubank, these are businesses that got VC funding. And if you look at Wise today, Nubank, I think Nubank at some point was like the most valuable fintech out there. Revolut is doing a lot of big things today. I just heard yesterday that they're trying to open a bank in Israel, for example. The expansion has been great across Europe, in the UK, in the US. So again, there are real stories about people getting VC funding and being successful, people bootstrapping and being successful, people only tapping into angel investment and still being successful. That being said, how do you really decide? What's your decision framework? How do you decide on what path to be? It depends on what your personal goals are. Would this be a business you want to stick with forever, or are you looking for a quick exit, right? If you see businesses that are going out for quick exits, they move very quickly. They come into the market, make a lot of noise, acquire a lot of customers, process a lot of transactions, especially in the fintech space. They make a mark very quickly, and that's because they're on a path for either an IPO or to exit. And the other consideration you want to have is how fast do you want to grow? Are you okay? Are you satisfied, or are you okay with organic growth, or you want hyper-scaled growth? If you want hyper-scaled growth, VC investment will be the best for you to go for, or you need an angel investment to at least kickstart you on that journey. Typically, when people raise angel investment, for example, they still raise VC investment down the road. What exactly is your vision for the business? Like I said, your ultimate vision for the company, how much of equity within this business are you willing to cede for you to grow? So those are the things that you want to consider when you make this decision. And what exactly are your needs beyond capital? Like I said, beyond capital, VCs can offer you connections to existing companies they've invested in. So take, for example, QED has invested in Remitly, ShakePay, and so on and so forth. That means it gives them some perspective about remittance. It gives them some perspective about cryptocurrency. They invested in MoneyPoint, for example. It gives them perspective into agency banking in Nigeria. So if you're in that space and you're looking for a VC to pitch to, QED might be. I'm not selling QED. I'm not upselling them, by the way. I just know them a lot more intimately than most of the VCs out there. So QED might be a place you want to go to try to pitch to them and see whether your idea is worth them listening to. Beyond the capital they give you, there's guidance they're able to give you. They're able to connect you with other founders that would help you on your journey. And again, your personal risk, right? How much of yourself are you able to give to the business? In terms of personal risk, are you able to take loans on behalf of your business? Maybe tap into a line of credit if you're in a climb where line of credit exists. Are you able to tie into a personal line of credit to grow your business? If you're not really ready to take that risk and you still need to grow your business anyway with funds, then you probably want to consider outside investment. Needless to say, I would say that the most important thing on your journey to growing your business is the people that you have on board. It's one thing to have $500,000 and not have the right resources to grow the business the way you want it. It's another thing to have what's it called? It's another thing to have that amount of money and you don't have the technical expertise to guide yourself to where you want to be. I think I've gotten to the end of my slide. I can take questions now.
Thank
All right.
you so much, Tolu, for the session. So I'll just read from what I've written here. From your experience, and specifically in the Nigerian context, what would you say is the average size for angel checks? And also, so in this context, I'm referring to, I don't know if angel, I know angel is like a little more further along than family and friends, but say, trying to raise from within like your network where you don't have to do too much of explanation because these people already know you to an extent or trust you. So what typically would be the average size for that kind of fundraise? And also, are angel investors typically open to safes? Especially when it's not like the institutional angels, or do they prefer to get their cash back after a while? Because some of these people may not be familiar with like the institutional kind of the way of constructing the returns that they get. So would they typically prefer to get their cash back, where you structure it as a type of debt that they get maybe when you finally move to an institutional fundraise?
Yeah, that's a very good question. What I'll say is there's no minimum, there's no maximum that an angel can give you. An angel will give you based on what they can afford. I've seen people, I think they call themselves syndicates or something these days. I've seen people hear about your idea, they like it, and they run along to go and tell friends that they know that have more money than themselves to come together and pull funds to give you. Right? They are still angel, it's still an angel investment, but they might not necessarily have all the money that you need. So what determines the check pretty much is how much do you need? So let's say I want to raise a pre-seed, for example, where you're trying to just get any amount of money, let's say 500K, for example. You can find an angel that can give you 500K if he has it and he likes your idea and it wants to join you on your growth, right? It can give you 500K. The terms of what it's typical it will be, I hear most people are open to safes, to be honest, because the agreement is standard, right? Most people are open to safe, but what determines how they get their cash back is what you've built into the agreement from the get-go. It could be that give me 500,000 in a year's time, I'm going to give you 10% plus your capital back. Or if I decide to raise down the road, we can convert this to equity. It depends on what agreement you sign with, what's it called, with the angel investment that will determine what they're comfortable with. And I think what people are comfortable with is really dependent on how much they believe in what you're doing, right? In some cases, I can absolutely believe that, you know what, this is going to blow. And don't worry about anything. We will make this happen together. And people just look at it from a lot of terms because they are really sure that this is solid and this is ironclad. In some cases, if we're not so sure, then people try to build some guardrails into the agreement that they have with you. But with respect to the size of checks that people are willing to give, it could be 10K, it could be 50K, it could be 100, it could be 500K. Actually, I don't know of an angel that will give you $1 million too. But again, it could happen that you find an angel that will give you $1 million. It all depends on what the angel can afford.
Mr. Shola, good to see you here. You want to ask a question, or should I read it out for you? Let me just read it out. He says, as you have been bootstrapping, have you given equity to your staff? How have you managed that?
Their staff, right? For early on guys that worked with me, everyone had equity in the business because to be honest, there's no way I can guarantee you would return if you're coming to nothing. So early on, the guys that started working with us, they had equity in the business and they still do till today, right? Our staff today, not so much, right? Of equity has been seated at that level. But for the guys that we started early on, yes, they have equity in the business. With respect to managing that, there's a lot of transparency in our business. I mean, everyone has a fair idea of what is going on. So you know when the company is reinvesting and don't come and asking for stuff at that point in time, right? One of the things I say we do, we're a very close-knit business and we look after ourselves significantly. So you can see one of our early equity members, for example, you could be cashing out and I'm not cashing out. It doesn't mean that I won't cash out at some point, but we just look at our sales staff and we consider it as business expense. That being said, early on, we see that equity to people that work for us.
Right. Thank you. All right. Thank you, Mr. Shola. Another question here from Charles Darrow. Hi, Charles. So he says, thank you so much. I'm a happy Pesa user. How did you know it was time to go full-time on Pesa? I think he's referring to leaving other franchise and then just other end of
That's a good question. I think two things happened. One of our co-founders said we looked at our bank bills and it was so high, but we were paying them every month. And the question was, why can't we just pay ourselves so we can work full time? That was one of the inflection points at which we started thinking about going full time. But for me personally, so in my 9 to 5, I had a meeting. It was 4 p.m. Typically, I wake up at 3 a.m. to start looking after business. I mean, my personal business. And by 4 p.m. in the evening, I'm already very exhausted. So on this day, I had a meeting at 4 p.m. That was for 30 minutes. And I woke up around past 5. And when I said I woke up at past 5, I started the meeting. I turned off my camera, turned off my microphone, and I slept off. It was at that point I knew that there was no way I could, humanly speaking, combine both businesses together. And I had to really pick the battle. Which one would pay me more? Pesa would pay me more, salary-wise, at that time. That was one. The second thing, the future too, Pesa would pay me more. So where would I really spend my time? At Logitech back then, to be honest, I had seen most of the things I wanted to see in my space, right? And even if I stayed at Logitech, even if I was still working at Logitech as what's it called? Because I was a senior solutions architect, and even if I was working at Logitech, I started picking interest in other things. So it was at that point that I knew that I needed to really focus on Pesa full time if we wanted to win.
All right. Thank you. There's a follow-up question still from Charles. I think he anticipated your answer. It says, also, how do you balance sustainability with ambition? How do you know you are not playing small?
There's something they say, know thyself, right? Playing small is really, really relative, right? Which is why I said, when you consider what you want to be, how big do you want to be? How fast do you want to grow? You need to be able to answer those questions by yourself. That would help you determine whether you're playing small or you're really playing big. You understand? Just to let you know, I've seen companies that raised hundreds of millions of dollars and they are no more today. I've seen companies that grew sustainably, they still exist today. I've seen companies that raised hundreds of millions of dollars and they still exist today. You just have to ask yourself, what exactly do you really want to be? You yourself, the founder of the company, what do you want to be? Forget about playing small. At the end of the day, maybe I can speak for myself. I just want to be happy. So you need to ask yourself, what is the need for you? What's the motivation for you to doing this and whatnot? You can look at your transaction size. Let's say you're in a fintech, let's even say you're in a remittance space. Look at your daily transaction volume and ask yourself, how much am I taking on from this? Because you can be processing $1 million a month. I'll give you an instance. There was a time we processed at 0.1% margin. And I'm just going to say this because 0.1% margin. For what? For big volume. Who's my business with big volume? Big volume is good for, we process $100 million a day. But how much did you really take home at the end of the day? So those are the questions you want to ask yourself. Look at your margins, look at your revenue, look at your profits. That should direct you to where you want to be. And again, if you're the type of person that wants to build your business such that you want to cash out, you want an exit at some point, then to be honest, cutting VCs would be the best way for you to go about it. Because if you build something very good and you take it to VCs, they like it, they back you, they can give you, let's say, 5 million for Series A or 10 million for Series A. Series B, you raise another 50 million. Series C, you raise 100 million. And maybe, just maybe, you're looking at the next level Shopify, for example, where as a founder, you have maybe 16% of the company and the company is valued at 1 billion. 16% of 1 billion is 160 million. If you sell 6% of your shares, you have $60 million in your pocket. So it depends on what you want to build. Everything comes with its own burden. You have to ask yourself, can I really carry this burden as much as you? I mean, can you really carry this burden as much as you want the result of the burden? Can you really carry it?
Right. Thank you very much, Mr. Tolulope. All right, I have a question for you though. So I mean, we've heard about all of the advantages and potential, disadvantages with the parts, but I'm curious about Pesa and yourself. I think right now you're bootstrapped. Would you and the team ever consider raising? And what would be the pivotal moment, or what could possibly be the pivotal moment that would make you consider raising? And I'm asking this question because I feel like there has to be something that changes in your mindset to move from, hey, I'm bootstrapping, right? Because we saw examples, no chain, bootstrapped, they've not raised. You could stay on that path and just stay there forever. But what would likely click for you to say, hey, you know what? I need to raise or maybe get, angel fund?
Well, they say that in this life, change is the only constant thing, right? So I wouldn't say we're bootstrapped for this long because we'll never consider raising. I wouldn't say that is why we're still bootstrapped today. And I wouldn't say that we would consider, I wouldn't say this would be the reason why we would consider raising. Raising has a lot of advantages, I must say. Number one, it puts you in the media. Number two, it tells people that there are people that have done due diligence about you or about your business and they're comfortable with it. And these are not just low lives, these are, like you said, institutional investors. These are people that know what they are doing. So it puts some sort of certificate, like a stamp of what's it called? Like a NAFDAC check on you, for lack of a better word, right? Such that when bigger businesses are looking for who to partner with, they'll consider you because, yeah, of course, you've pulled in this amount of money, and that's because you're doing something fantastic, or you have the right your business is in the right trajectory. So with us, for example, like I said, there are multiple reasons why anyone can raise. So take, for example, if I want to become a global payments provider, for example, I could consider raising. Maybe not because I necessarily need the money, but because I want that stamp of authority to say, oh, we are backed by this, we are backed by this venture, we are backed by this venture. You get what I mean? So that could be a reason for us to go out to say we want to raise, right? People also say that the best time to raise is when you don't really need the money. You get what I mean? And that's because you're not pushed for it, you're not desperate for it. Your communication would always be clear. You get what I mean? So with respect to whether we raise or not, I can't tell that today. It might happen in the future. I might come out next week to say we raised $5 million or $10 million. I can't tell. But as we are today, we're still a bootstrap company and we're growing the business at the pace at which we're growing. And to be honest, we like the pace at which we're growing. I think one of the questions that I see is from Kaya Days, given the profitability of the business hinges on transaction volume, which is driven by your customer and user size, what's the most effective user acquisition Pesa adopted early on? I think one of the it's really word of mouth. You understand? If you have a good product, people will talk about it and it will bring people on board. That being said, word of mouth is not enough, right? For you to word of mouth, when you're a small company or when you're a great company, word of mouth is not necessarily enough to give you the tipping point effect or the ripple effect that you're looking for. So we did a couple of what's it called? We did a couple of digital marketing ads, right? And we really optimized for low cost when doing that. We optimized for low cost. And what we also do today is as you might know, we spend on influencer marketing, right? Again, our spending is usually a percentage of the revenue we make. It's a fixed percentage of revenue we make. It's not going to grow beyond that. However, if we have spare funds in it, we'll spend more on marketing, as the case may be. So early on, we didn't do a lot of what's it called? We didn't do any ads, we didn't do any campaign, we didn't do anything until 2023. So it's 2023 we started really doing Facebook ads. As a matter of fact, we didn't also even do it because it was a strategy. We didn't know. Just to let you know, we didn't know we were supposed to do it. So it wasn't necessarily a strategy of us that we didn't know. One of my co-founders used to say, "Oh, we need to do marketing. I said, "No need for all of those things. I just want to waste your money." But we didn't know. That's why we didn't do it, and it kind of worked for us. But I would say that most of the users we acquire today, we've acquired them off the back of marketing. We try as much as possible to keep our customer acquisition cost as low as possible because, again, I don't believe you have to spend quite a lot of money to get customers. But these days in the field we exist in, you do have to, and which is why I said you have to pace yourself. If you don't have the money, don't spend it. Don't look at the other guy that is taking in, that is saying, so take for example, Lemfi said, man, you did 1 billion or something. I'm less concerned about their billion because if you ask me to come and do 1 billion today, to acquire the customers that will give them that billion, I don't have that money. So I'm just happy on my own journey. You understand? Focus on what you're doing, really double down on what you're doing. And to be honest with you, you're really going to win. Down the road, if you ever want to raise, a VC would look at you. At that point in time, you're going to have sustainable metrics. You're going to have fiscal discipline. You're going to have domain knowledge to pitch to a VC to invest in you. Remitly was here before all of us. World Remit was here before all of us. Lemfi came. Lemfi is a big provider in its by its own right. You get what I mean? If you look at the banks in Nigeria today, GT Bank was there for a long time. MoneyPoint is doing wonders in Nigeria today. So you're never going to be late to the game. Definitely, there's a time might pass, but to be honest, if your metrics are good, if your business indicators are good, you will still get a capture of the market for yourself.
Right. Thank you very much, Tolu. Okay, I think that brings us to the end of this session. It's been interesting. I really loved the points that you highlighted in your slides. So yes, we'll address all the questions, and I think we all learned at least one or two things that we can, use in our businesses, in our products, even as operators or founders, in our rights. So yes, thank you for joining us, Tolulope. We hope that we can, see more of you. I'm thinking of, potentially bringing you back for another session that I have in mind. Hope that when I reach out to you, would oblige us once again. Also, thanks to everyone who is here for starting with us and staying till the end. We do not take your attendance for granted. All right. So see you next time.